Today we discussed Russia's continued military build-up in and around Ukraine. The risk of conflict remains real, and we continue to call on Russia to de-escalate and choose the path of diplomacy.
I had a very good meeting, total unanimity with all the European leaders.
The Federal Reserve has been behind the curve, slower to tighten monetary policy. And as a result, we're now starting to see the rise in interest rates to be able to deal with that.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London, and here's what's coming up on today's program. European stocks rebound after the S&P 500 stages its biggest turnaround since 2008. Wall Street looks set to open lower. Eastern Europe on edge. The U.S. puts thousands of troops on alert amid diplomatic efforts to defuse the Russia-Ukraine crisis. Plus, Credit Suisse warning the embattled lender says fourth quarter profit will be hurt by about 500 million Swiss francs of litigation provisions. Now, first thing is first, let's check in on the markets, and then we have a deep dive into a lot of these big stories that we have been watching. Now, yesterday was a pretty breathtaking session. Certainly volatility, it was back with a vengeance. The stocks in the U.S. down around 4%. And then at the last minute, we had a lot of dip buying, and they actually ended up in the green. European stocks today getting a lift off 0.5% higher. The focus, of course, on the Fed. We did have also Australian inflation smashing estimates. That could be repricing some of the expectations that some traders have on Fed tomorrow. Interesting to see, again, the dichotomy. European stocks maybe doing a bit of catch-up, certainly with some of the tech that we saw yesterday, and S&P futures actually on the lower side. The U.S. 10-year yield at 1.789, and then dollar-ruble, the one to watch out for in terms also of Russian ETFs, where we saw huge outflows because of what could happen in Ukraine, currently at 78.67. Now, we also had that Germany January Ifo business confidence coming in a touch better than expected, 95.7. The estimate was 94.5 because of the focus on energy price, because of what's happening in the geopolitics with, for example, the U.S. saying they have 8,500 troops on alert to send to Eastern Europe. It's interesting to see that actually Ifo confidence was a bit better than expected despite those rising energy prices. For the moment, you can see the DAX, the FTSE MIB, where there is the presidential election ongoing, and here the FTSE gaining some 0.4%. Now, we're also joined to talk about the markets, treasuries, the Fed, and everything in between by Scott Thiel. He's the chief fixed income strategist at BlackRock. Scott, thank you for joining us. I mean, there is so much to talk about. Let's start with the volatility. Is it the different type of investor that was selling and buying yesterday? Is that how you explain it? Or is volatility back?
Well, I think it's both. I think both its volatility is back, as there are obviously concerns about policy and also about political tension. But also, Francine, one of the things we have seen is that in the selling, as we look through our our franchise, we see both retail and institutional selling. So I think both sides of the of the party here have been involved, both the retail and the institutional side.
So, Scott, what does it mean for actually how much flatter the yield curve will go?
Well, I mean, I think, we're going to get some information on Wednesday about monetary policy going forward. And one of the things that we've noted is that although the sum total, I think this is very important, the sum total of rate hikes over the cycle remains around the same as it did prior to Christmas, the pathway is very different, right? And so what we have seen is that the market is now expecting, much more monetary policy tightening in this year and next year than it had previously. At the same time, we're also going to get information about the QE unwind and potentially about the runoff. That will also be very important. So on balance, we would say that rates are going to move higher over the course of the year and the yield curve will steepen. But in the near term, we see some stability, which is why we've taken back some of our underweight to treasuries this week in our weekly view. But the idea would be that policy is going to be obviously very important in terms of yield curve direction. We should get some information about that on Wednesday.
So, Scott, at this moment, I know we had an inflation print that actually smashed estimates in Australia. Does it make you change your view on what could happen to inflation in the U.S., or are we still separate, quite separate in terms of various regions?
I think the regional differences are really important right here, Francine. And I think one of the things that we have highlighted over and over again here, and this is mission critical for understanding markets, performance, equities, and fixed income, is the supply constraint nature of inflation. right? And that is a very important thing to keep in the frame as you try and evaluate, your market views, right? This is not kind of a normal business cycle, not a normal inflationary environment driven by an economy overheating. This is about supply constraints, whether it's COVID related, whether it's the transition to net zero, and whether it's geopolitics, right? So it's a very different environment.
Scott, where do you see the most value then in fixed income? I don't know whether you go, we'll talk about Europe and Italy in just a second, but
Sure.
Regionally, where does it look more attractive?
Well, we do like emerging market local bonds as an overweight for us. We note that the rate increases there have been substantial. Yield is much higher on the index. The currencies have been under pressure. And as we look going forward and we see the balance, of policy shift, we do like emerging market local bonds. And again, noting both from the rate perspective, because we've seen increases already and further are priced in emerging markets, and because of the underperformance of the currencies. Again, inflation protected bonds with U.S. break-evens around 2.5%, slightly lower. We still think that is an attractive asset to own, particularly because we think longer-term inflation is closer to 3%.
Scott, thank you so much. We'll have plenty more, of course, from Scott throughout the day. Scott, the other chief fixed income strategist at BlackRock. Now, coming up, high alert. The U.S. gets troops ready for deployment as NATO shores up defenses in Eastern Europe. We get the latest live from Kiev later on in the program. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's get back to the markets. And joining us with the very latest is our Danny Berger. Danny, we were just talking about volatility, and you have some great charts to illustrate it.
Yeah, I definitely do. When we look at yesterday, one of the questions has to be, what does this turnaround mean for markets? Does it mean that there is more concern bubbling under the surface? And I've come prepared with stats that unfortunately do suggest so. So yesterday, we saw the sell-off of nearly 5% intraday for the Nasdaq 100. It ends in the green. Now, this isn't unusual. It's happened 11 times before in the past, but the times that it's happened before are not exactly comforting. 3 times in 2008 and 11 times during the dot-com bubble. So not great historical corollaries there. But more than anything, one of the instruments that really showed angst coming through was the ETF that tracks this index. That's, of course, the triple Qs from State Street. Now, this ETF, if I can use a technical term, the trading on it was absolutely bananas yesterday. So we saw volume on this thing hit the highest level ever. More than $68 billion worth of this ETF was traded yesterday. That's more than $25 billion past the prior record. And not only that, options underneath the surface, that also hit a record, and that was led by put options. Now, usually when there's angst in the market, it will show through on ETFs because this is a very liquid instrument. It's easy to trade in and out of. So, Francine, this gives us a really good sense of how investors are feeling about this market and how they're fleeing to protection and trading a whole lot.
I love that, Danny. It's bananas. This is like the real technical CFA level 25 that we need in our lives. Danny Berger, there was some really great charts. Scott, what's most bananas when you looked at the fixed income and you specifically look at Europe? I don't know whether it's, the correlation between Italy and Germany. I know the ECB is staying pat, but at some point it will change, or whether it's the pricing of gilts.
I mean, I think, in Europe, one of the things we've noted, obviously, is that, BTP spreads have widened. Obviously, we're talking about Italian elections earlier in the program. Part of that, I think, is Italian politics, and part of it, which obviously is a very complex situation, and part of it also is that, as market participants look at the unwind of the QE program in the U.S. and the decreased purchases by the ECB, they can't help but, kind of make some assumptions about the two markets. And one of the things we have noted is that European government bonds have performed very poorly here, with really not the same dynamics, right, at the ECB as we're going through at the Federal Reserve here. And so I do think it speaks to the global nature of fixed income, but it also speaks to kind of, investors are concerned about what's happening in Europe as well as the U.S. And one of the things I would note, it's interesting, Danny's comment about the increased volatility. One of the very big differences between fixed income and equity markets is that in huge amounts of volatility, equity volume goes way, way up and fixed income markets go way, way down. And it's an important difference. And so I do think trading volume is an interesting indicator of volatility.
Scott, what happens when the ECB stops buying some of the bonds?
Well, I mean, they've projected a decrease in the amount of purchases, but very importantly, right, they remain a purchaser through time, and they've made that very clear. And so it's not the same, same dynamic. Obviously, the ECB's position in the market is very, very pervasive, right? And the amount of bonds that they own across all the different countries, in Italy in particular. And so market participants, I would argue, are more focused in some respects on the purchase program and how that goes forward, and are pricing Italian spreads with that more than they are, I think, with Italian politics. But I do think, Francine, it's a very important, the supply-demand dynamics in Europe are mission critical. And the ECB, again, has told us that they're going to decrease the amount of purchases, but remain a buyer through time.
When you look, Scott, at some of the things that, in terms of repricing, if Mario Draghi leaves the Italian government to become president, and, we have no clue or no insider knowledge at the moment whether that will happen, but he is still the front runner, what happens to the spread?
Well, it's interesting. We think in the scenarios that we've played out, that may be our most likely scenario where he becomes president. And in some respects, actually, we think that may be positive, particularly if it's with a high majority, because what that might allow is a centralization of some of the fringe parties to continue, Francine. I think that's a very important underlying theme here. And so, again, we would look for, we haven't had a particular view on Italian politics because of the uncertainty of Italian spreads, because of the uncertainty of politics and the ECB. But when we look at it, it starts to look attractive to us at these levels. Again, I do caution, I think that the QE program and perceptions around the ECB are as important as Italian politics for the overall level of the spread.
Scott, I don't know what you do with UK assets right now. I know there's like Partygate, but at the same time, there's also talk about raising taxes in April and what that means for a fixed income buyer.
Yeah, and I also think, so gilts, gilts have taken their cue from treasuries in some respects, and also from the Bank of England. But I think also the important thing here, right, is that the gilt holdings by the bank are also going to obviously be under scrutiny as rates increase. As you know, they have a QE program or QT program that is tied to the level of interest rates. And so as the bank tightens, we'll see that portfolio shift. So I do think there is pressure on UK rates, as there are in other major, risk-free rate markets. And in particular, the Bank of England is active, as the Fed will be shortly. And so I think the same dynamics exist there, Francine. In other words, focus on policy, a focus on the bank's holdings as rates increase, given their kind of rule-based approach.
Scott, we haven't even really touched on what's happening in China with some of the fixed income space and even, renminbi. How do you trade, or how do you look at China in the next 12 months?
Well, we're positive China both in equities and in fixed income, and is primarily based on this idea that we would see a policy response to the slowdown in economic activity that was a result in part of the kind of later nature of the far forward nature of the COVID and also the clampdown issues. What we've seen here, obviously, is that China's taken a very different approach to COVID in terms of their dealing with it and the outbreaks. But we would, again, still say that the policy, we're starting to see that, right, easing in monetary policy, easing in regulatory policy as a positive for both Chinese bonds, which we are overweight, and Chinese equities that we're overweight. Still positive on China. Note dramatic, because of the volatility in U.S. stocks, but dramatic outperformance of Chinese index in the first couple of weeks of this year.
Scott, thank you so much. Scott Thiel, their chief fixed income strategist at BlackRock, joining us this morning. Now, coming up, Germany's Ifo Business Confidence Index rose in January. Economists were expecting a fall. And we speak to the Institute's president, Clemens Fuest. We also talk about energy prices and Russia. That interview is up shortly. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Germany's Ifo Business Confidence Index rose in January. Economists were actually expecting a fall. We're joined to talk about this by the Ifo Institute President Clemens Fuest. Mr. Fuest, thank you so much, as always, for giving us commentary surrounding the Ifo number. Were you surprised, but actually the strength of the economy? And is it surprising given the energy prices and that volatility we've seen over the last couple of months?
Yes, maybe it's surprising. What we see in the data is that businesses are telling us the current situation isn't really great. So it's even a little worse than in December. But for the coming months, companies are expecting an improvement. And that's what's driving the Ifo index in this case.
So, Mr. Fuest, how do you expect actually the economy to operate in the coming months and quarters?
I would expect the economy to be subdued in the first quarter, and this is related, of course, to the Omicron wave, to continuing supply chain disruptions. But I would expect an improvement in the summer when the Omicron wave will hopefully have been overcome, and linked to that when supply chain problems are easing. So the expectation is we will have a good summer. Households have a lot of savings they would like to spend, so there is potential for a stronger recovery in the summer.
So how do you expect the energy prices and actually this ongoing tension with Russia to play into, people's thinking and confidence for their future?
That's certainly a big unknown. So what we would expect without changes in the Russian-Ukraine situation would be energy prices to remain high but not to increase further. Of course, if there is a conflict, if there is an armed conflict in Ukraine, there may be spikes in gas prices, and that may certainly disrupt the economy more, and it's very hard to predict how that plays out. So our scenario currently is that there will not be an armed conflict, and energy prices, yes, they will remain high, but not increase further.
I mean, we had, Australian inflation data that smashed expectations. Are you expecting any inflation shocks?
We do see in the data that a lot of companies intend to increase prices, so price pressure will remain strong. At the same time, we have these base effects. For instance, the VAT cut, which was phased out at the beginning of last year, and this will bring down inflation readings. So overall, we expect high inflation rates in the first months in Germany and the Eurozone, but then we expect these inflation rates to gradually go down. Of course, this depends on a lot of factors, one being energy prices not skyrocketing, the other being that other import prices like foods, commodity prices not increasing significantly. So there's a lot of uncertainty in there, but due to the base effects, there will be a tendency of inflation rates to be coming down. So I wouldn't expect an inflation shocks. Also, demand will go back, be channeled more to services once the Omicron wave is overcome, and that will also contribute to the easing of inflation in the Eurozone. Here, the situation is a little different from the US, where inflationary pressures are certainly strong.
But, Mr. Fuest, if you have, an inflation ticking higher, is this because of supply chain constraints, or do you think it's actually demand? Is it the healthier kind of inflation that could be coming through?
In Europe, it's unfortunately the less healthy kind of inflation. It's coming more from the supply chain problems. If we compare demand for goods in the US and the Eurozone, it's weaker in the Eurozone. It is there, but it is not as booming. So it's not the factor driving inflation in Europe as it is in the US.
What do you see, Mr. Fuest, the right, policy mix? I don't know whether the fact that we're looking at a presidential election in Italy, and we're also looking at the French presidential election over in April, could, significantly change the composition of the Eurozone and therefore impact Germany.
I think the expectation is Macron in the end will win the presidential election. In Italy, there's more uncertainty, but not the expectation that these elections will create major problems. That's why I would expect no significant impact from that side. Overall, in terms of policy, I think the ECB should slowly continue phasing out bond purchases. it's probably too early for interest rate increases, but of course it needs to watch the inflation rate.
Wonderful. Thank you so much for all of your insight. The Ifo Institute president there, Clemens Fuest, joining us this morning. Now, coming up, Credit Suisse closes out a year marred by scandals and turmoil at the top. We'll have plenty more on that story. That's coming up next. And this is Bloomberg. European stocks rebound after the S&P 500 stages its biggest turnaround since 2008. Wall Street looks set to open lower. Eastern Europe on edge. The U.S. puts thousands of troops on alert amid diplomatic efforts to defuse the Russia-Ukraine crisis. Plus, Credit Suisse warning the embattled lender says fourth quarter profits will be hurt by about 500 million Swiss francs of litigation provisions. Good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, first, let's check on the markets. Wow, what a volatile day we had yesterday. It was really breathtakingly volatile. At certain points, we saw, according to JP Morgan, actually a sell-off from retail investors at around noon. And then, actually, buying the dip mentality came in and supported a lot of the U.S. stocks. That's filtering through to European stocks today. But then the S&P futures are down some 0.8%. On to corporate story number one. Credit Suisse saying it will set aside 500 million Swiss francs for litigation in the fourth quarter. Now, the bank also warned of outflows in its key wealth business as clients pull back, particularly in Asia. Now, the charges cap a year that has seen Credit Suisse reel from the collapse of both Archegos and Greensill, as well as the ousting of their previous chairman for breaching quarantine rules. Now, let's bring in Bloomberg's European banking reporter, Tom Metcalf, for the very latest. First of all, Tom, I have to correct also myself because I was quite clumsy the last time you came on. So 500 Swiss francs is about $525 million, which is nothing to be snobbed about. This is still a big number.
Yeah, no, exactly. I mean, look, it's more bad news for Credit Suisse. It's perhaps not at the same scale as an Archegos, as a Greensill, but investors in the lender must just be wondering, will they catch a break? The whole year, you've seen AHO leave. It's just been a series of bad news.
Yeah, and I feel like we've been saying this for a couple of years. Will they ever catch a break? I mean, what do they need to do? First of all, we don't really know what this is related to. So could it be the end of something that was bad news, or could it be the beginning of something?
Yeah, exactly. I mean, that's the hope. It's Q4 earnings, so they're taking a big restructuring charge beyond this 500 million. I think it's 1.6 billion for restructuring. So, supporters or optimists might say, you know what, the slate is swiped clean. 2022, here we come. But, this is banking, and you tend to get surprised by things as each quarter comes. So
how do they get out of this? And again, what needs to happen for them to have a clean slate?
Well, I mean, pretty drastic shift right at the top with the chairman moving. And I think what they just need is some stability, right? Kind of just a couple of very boring quarters, focus on the sort of nuts and bolts of the business. That will sort of help restore a bit of confidence, I'm sure. And then, you have these bigger picture ideas. Does Credit Suisse, look to M&A, or does it sort of look to maybe farm off some small assets?
Does it make sense? And would the regulator even say yes to it?
I mean, that's the tricky thing, especially with all cross-border M&A, but particularly Switzerland. Would they really want Credit Suisse to sort of team up either with a Swiss bank or an overseas bank? Big questions over that.
Big questions, but I know our Tom Metcalf and, of course, all of his team will be across it. Tom, thank you so much, in charge of our UK banking team. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Here in the UK, Boris Johnson is facing further allegations of holding parties during the pandemic. ITV reports up to 30 guests attended a Downing Street birthday celebration for Johnson during the first lockdown in 2020, when most indoor gatherings were banned. Johnson's office says staff gathered, but the Prime Minister was present for less than 10 minutes. Now, German Chancellor Olaf Scholz is holding firm on a refusal to supply weapons to Ukraine, despite criticism that the stance undermines efforts to deter a Russian invasion. Scholz said Germany will stick to its long-standing exporting weapons to conflict zones, adding that Berlin is prepared to support Ukraine in other ways, including training. And Rio Tinto has struck a deal with Mongolia to start work on a long-delayed copper mine in the south of the country. The agreement sees the cancellation of almost $2.5 billion of debt owed by the Mongolian government for its share of construction costs. Production from the $6.9 billion mine is expected to start next year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thank you so much. Now, the first round of Italy's presidential election saw no winner as an agreement in the country's divided parliament remains far off. Now, voting is set to resume today with the current Prime Minister, Mario Draghi, seen as favorite to be picked as the new head of state. Now, we're joined by Carlo Cottarelli, director of the Observatory on Italian Public Accounts at Università Cattolica. In 2018, Carlo served as Prime Minister of Italy for a short period, having been appointed by the President Sergio Mattarella. He's also former director of the IMF. So thank you so much, Carlo, for joining us. First of all, how long will the process take? I know it could take, anything between like 2 days, 3 days. Are we any closer to having a candidate that would be supported by enough parties?
We don't know how long it's going to take. I'm relatively optimistic that a solution, an agreement can be found in a matter of few days. The first 3 votes require a majority of 2/3, and I don't think it's going to happen. Today is the second vote, but by the day after tomorrow, only a 50% majority, 51%, 50 plus 1, will be sufficient. And I think an agreement is going to be reached relatively soon. That's my expectation.
Yeah.
But we have to see. It's still very uncertain.
So what happens, and I guess this is what the market is most worried about, that Mario Draghi, the current prime minister, which has brought a lot of stability, which to the markets and the international finance community will be picked to become president of Italy, therefore leaving a void, of course, as a head of state. What does it mean if Mr. Draghi becomes president?
It depends on whether the appointment of Mr. Draghi as president also comes with an agreement on what happens to Palazzo Chigi, so the Prime Minister's office. What happens to the Prime Minister? Who will be the new Prime Minister? The two things will have to be, in my view, agreed together. But the shape of the agreement for if Draghi becomes president of the Republic, the shape of the agreement will be very important, because if there is an agreement that is clearly not going to last, there may be a negative market reaction. I don't expect, however, that there will be an immediate market reaction. It's going to take a while for markets to look at what is happening, what will happen. The interest rate spread has already increased in the last few months. It's about, yes, there was 140 basis points. I don't expect a dramatic market response. But over time, if the government that follows Draghi's government, if Draghi goes, is a government that is weak, then there will be a market reaction.
But how do you see this playing out exactly? So, if Mr. Draghi becomes president, are the EU funds at risk? Are the reforms at risk? Or would an agreement on who would become prime minister automatically try and put some stability in place?
No, the worst scenario would be to have, worst scenario at least in the short run, would be to have a government that is unstable, and therefore after a few months it has to resign, and then we go to general elections pretty soon. That, of course, will probably stop the reform process for the year. And then it depends on the outcome of the election. The most, in a way, reassuring form of government would be what has been proposed, for example, by Mr. Salvini, the leader's government. Draghi becomes prime minister, and then there is a government where the heads of parties put their own face directly, which is probably, in my view, the only solution to have a government that lasts until the spring of 2023, when there would have to be, in any case, general elections.
So do you think, but what is the likelihood actually of these general elections this year in 2022? Is it a 50% chance?
No, it's probably less than 50%. But the risk is also that you have a government that is weak, and does not carry forward the reforms as strongly as needed. 2022 is a very important year in terms of reforms because many of the laws, the reforms that were implemented last year were simply, I hope the term is exact, enabling laws. Laws in which the parliament would ask the government to write the decrees that are needed to make the changes in the legislation. Those decrees will have to be written this year. And here I'm talking about the reform of justice, the reform of the fiscal system, some aspects of the reforms of the bureaucracy, and so on and so forth. There is a lot of stuff that has to come this year. And on top of this, the European fiscal rules will have to be renegotiated this year. So it's very important who leads the discussions for Italy.
Yeah, so what is at risk? And I know for an international, especially finance audience, there's, so many groups that it's very difficult to see, what kind of name could emerge. Do you have a hunch of who could replace Mario Draghi if he becomes president?
No, that's very uncertain. There are some names that are circulating. The main choice is between somebody from the technical side, let's say, who is already in government. It could be the finance minister, Daniele Franco. It could be the justice minister, Marta Cartabia. The other solution would be to have some politicians. But in my view, is that if there is an interim if there is a government that is not led by Draghi, probably because it is a coalition government, they will have to find somebody who is relatively neutral, and therefore could be a more technical person.
All right, Carlo Cottarelli, thank you so much, Director of the Observatory on Italian Public Accounts at Università Cattolica. Now, coming up, President Biden declares total unity in the West after crisis talks with the EU leaders on Ukraine. We look at the Ukrainian situation. We look at the market action. Of course, huge moves in Russian ETFs. This is Bloomberg.
There is a confirmation of unity of the European Union. There is a confirmation to help Ukraine to address this crisis. And also there is a readiness to take measures if necessary and to impose new sanctions, both individual and sectoral sanctions on Russia.
Well, that was the Ukrainian ambassador to the EU on a united response on Russia-Ukraine tensions. President Biden, meanwhile, has declared that the U.S. is aligned with its allies, placing 8,500 U.S. troops on heightened alert for deployment to Eastern Europe, where they would join existing NATO forces. Russia continues to deny plans to carry out a fresh offensive in Ukraine. Now, with us to discuss all of this is Bloomberg's senior reporter for international affairs, Mark Champion, who is in Kiev. Mark, first of all, good morning. President Biden says there's total unity from the West. Germany, though, refusing to send weapons to Ukraine. So it doesn't look like a very unified Europe to me.
No, and the call yesterday was really to, fix some of the damage that was done in recent days as they argued about, what kind of sanctions to levy on Russia. The US and the EU faced very different consequences from those. And then again, of course, about what weapons to send and whether to send lethal weapons, Germany being a bit of an outlier in that, but not alone. So, yes, they are not unified, but it was important to have that call just to make clear what they do agree on, which is that they support Ukraine and that there will be some kind of response if President Putin decides to attack.
Mark, I guess one of the questions that we've been trying to figure out is what is Vladimir Putin's endgame? So is he trying to break up allies so that he rules by division amongst, for example, the US and Europe, or even within Europe, France and Germany? Or is it actually to take over parts of Ukraine?
The correct answer to that is that we don't know, and quite possibly all of the above. So I think the way that one has to look at this is that, President Putin's the goal that we know he has is to put as many options on the table as possible, to keep everybody guessing as to which of those options he plans to use, to leave himself in the driving seat in deciding the agenda and the pace at which things move. And so far, he's been very successful in doing that. It's a difficult, scenario for the rest of the world to respond to, because they really don't know what his preference is. And it's quite possible that he has not himself made up his mind as to what he will finally do.
Mark, I could have a conversation with you for about 10 hours because I have so many questions. What's it like, first of all, being on the ground in Kiev? So you look at the news, and I imagine everyone's talking about nothing else than a possible Russian invasion. But are people going about their daily lives?
No, absolutely. People go about their daily lives in Kiev, and that strangely, because I came all the way across from the east, I drove from the east where the front line is, and then all the way across to Odessa, and then up to Kiev. And quite frankly, the further you get away from the front line, the less calm it is. And there's fighting at the front line. It's been going on for 8 years, but generally people are just going. They go to restaurants. They talk. They're making business plans. They're investing. They're doing all these kinds of things, as though there was no threat. Of course, they know there is a threat. They just simply, I think, have decided that they cannot guess what's going to happen. So they simply have to make a decision. Do you pack up and leave? You close your business. You go away because you're afraid something might happen. Or do you just carry on and prepare as best you can? And largely they've chosen the latter.
Yeah, and I guess, Mark, it's a very difficult decision situation because you also don't know exactly what Vladimir Putin could do, right? If it's an invasion or maybe stopping at the border or just over the border. Mark, overall, when you look at the timeline of this, is Vladimir Putin playing for time and dragging this out also to destabilize his opponents?
I do not think so. I think that everything that they've done at the moment is to create urgency, to bring the timeline for diplomacy forward. I mean, the kinds of things that they're asking for from the US and NATO are very, very difficult, if not impossible, to achieve. And if they were to be truly negotiated, it would take years, frankly. So he's been pushing the agenda, forward. In order to, he wants this to be done in a matter of months, which is fast when you think about the kinds of things he's talking about, changing the security architecture in Europe, creating a sphere of influence, essentially, for Russia, making sure that, Ukraine can't join NATO, can't join the EU. These are very big changes in, the landscape in Europe. And he's made a very short time frame for them, I think.
Mark, thank you so much. Our Bloomberg senior reporter, of course, for international affairs, Mark Champion in Kiev, Ukraine, for us. Now let's get straight to the Bloomberg Business Flash. Here's Leanne Gerrans. Hi, Leanne.
Hi, Francine. Unilever is to cut 1,500 management positions to speed up decision-making. The move comes after activist investor Nelson Peltz built a stake in the London-based consumer goods giant. CEO Alan Jope is under pressure after a failed bid for GlaxoSmithKline's consumer healthcare unit. The company is also making ice cream an independent unit as it recognizes its business into 5 groups. And IBM has posted its strongest sales growth in 10 years thanks to growing cloud demand. Sales surged by 6.5% in the latest quarter, beating analyst estimates. IBM's hybrid cloud sales jumped 16% in the latest sign the tech giant's pivot to newer technologies is indeed bearing fruit. Credit Suisse is capping a year marred by scandals and turmoil at the top. The Swiss bank will book more charges for legal matters in the fourth quarter, plus it warns of outflows in its key wealth business. Credit Suisse has been reeling from the collapse of Archegos Capital Management and Greensill Capital, and chair Antonio Horta Rosario was ousted after 9 months after breaching quarantine rules. And that's your Bloomberg Business Flash. Francine.
Thank you so much, Leanne. Now, coming up, Boris Johnson under fire yet again. The scandal that just won't go away has a birthday twist. We have that story next. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now let's turn to the UK and UK politics. Boris Johnson under fire yet again, this time for attending his own surprise birthday party held in Downing Street during the first lockdown. The fate of the Prime Minister will be in focus this week when a report into rule-breaking parties at number 10 is published. Now joining us now is Bloomberg's David Merritt. David, it's very easy to actually laugh about all of them and saying, right, well, when did they not have a party at this point? Because there were just so many that you almost can't keep track of them. But with every revelation, will he have to resign? Will he be pushed out? How can the Prime Minister survive this?
But it does feel like every day there's a new revelation, isn't there? Another party. We're well into double digits here of the amount of these things that have now been clocked up. Downing Street not even denying this one, saying, yes, it did happen, but trying to downplay the significance of it or that it was really a sort of party. And many of his allies saying the same thing. But, you know, I listened with a lot of interest to Baroness Varsi. She's been the chairperson of the Tory party. She was on the BBC last night. She said, look, this is like the death of a thousand cuts. You know, it's undermining, every one of these revelations undermines further our image of him, but also more broadly about the office of the Prime Minister and Britain's standing around the world. And yes, it's a laughing matter, but when you listen to the stories of the people who were unable to attend dying relatives who were denied from all these life events, they don't find it funny at all. And that's what's so damaging about this, is that some of these stories are really horrific, what everyone went through this time of year. And time and again, we keep learning that the Prime Minister wasn't following those rules.
Yeah, and what's incredible, at least for me as a foreigner, is that this is the UK. I mean, the UK, which in the past has always held itself to the highest standard. So what are the Tories, you know, thinking about this? Is his party still sticking by him?
It's remarkable, isn't it, that actually many other Prime Ministers, you would assume, with only a fraction of these sort of revelations, would have probably have stepped down at this point. And look at the corporate world. Credit Suisse ejecting their chairman pretty rapidly with just a smaller infringement of the rules. This Prime Minister's made it very clear he's not going anywhere unless he's forced out. And, you know, it's going to be up to his MPs to actually do that this week. Do they have the numbers? You know, that is the big unknown at the moment.
But Dave, why do they still support him? I mean, is this man so charismatic that actually they can't win the next re-election? Is he so charismatic that no one else can replace him?
Well, just cast your mind back just a little bit over than 2 years ago. An 80-seat majority this man delivered, the biggest Conservative win since the heyday of Margaret Thatcher, persuading people across the whole country to vote Conservative who had never voted Conservative in their lives. And, of course, MPs are remembering that, thinking, well, who else in the current MP, in the current intake, can stitch together that sort of coalition and win again? And, you know, they're going to be asking themselves whether they've got any better alternative than this Prime Minister at this point.
So we'll see. I mean, can we call it? Will he survive it or not?
I think, you know, that is the million-dollar question. I think his position is looking very, very difficult indeed, but we're going to have to wait for this report this week. Yeah,
we certainly will. Everyone waiting for that Sue Gray report. Thank you so much, our head of EMEA News, David Merritt. In the meantime, markets, if you look at futures in the U.S., they are a little bit actually subdued, but here in Europe, we're still seeing gains. We'll have plenty more on that with Matt Miller and Kailey Leinz in New York and Edwards here in London. This is Bloomberg.
The Fed really does owe us an explanation.
The issues that are burdening the world and the sentiment of traders right now are stemming from the emerging markets.
There is a lot going on right now for the market to digest.
I think the market clearly doesn't like uncertainty. This is clearly a bit of a perfect storm.
This is Bloomberg Surveillance, Early Edition, with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, 5 a.m. in New York, and 6 p.m. in Hong Kong on this Tuesday, January 25th. Our top stories today. Stocks are mixed and U.S. futures are lower after that dramatic reversal put U.S. benchmarks back in the green. Investors still concerned, though, about higher interest rates and geopolitical tensions. Show of force. The U.S. is set to deploy 8,500 troops to Eastern Europe if needed. Meanwhile, the U.S. and Western Europe are still giving diplomacy a chance. Leaders discuss their options on Russia and Ukraine. And a bad year at Credit Suisse just gets worse. The Swiss bank will book more charges for legal matters in the fourth quarter, and it warns of outflows in its key wealth business. Welcome to Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And Kailey, in case we were under any doubt this January, volatility in stocks certainly is back.
Volatility back in a big way. Yesterday was an insane day, Anna. You saw losses of about 4% or more on U.S. benchmarks, actually ending the day in positive territory. A remarkable rebound That didn't really continue in Asia overnight. Instead, Asian stocks were broadly lower. The MSCI Asia Pacific Index down about 1.5%, and you have several benchmarks approaching very key levels. The Topix in Japan, for example, down 1.7% overnight. It is now in a technical correction, down more than 10% from its peak. And when it comes to the CSI 300 in China, it is now down 19.5% from its record high last February. So we are very, very close to bear market territory as it posted a loss of about 2.25% overnight. Of course, there are still a lot of strategists positive on the China story, given the easing coming from the PBOC, but a lot of central banks aren't going in the easier direction. They're going in the tighter direction, and that is true, too, in Singapore, where the central bank reacted to the highest inflation in 8 years with a surprise tightening move, and as a result, the Singapore dollar, the big outperformer in Asian FX, stronger against the U.S. dollar by about 0.2% to 134.39. And then, of course, speaking of inflation, it came in hot in Australia. That is refueling bets on an earlier hike out of the RBA, and as a result, you really saw a reaction in the short end of the curve in Australia, that 2-year yield of about 6 basis points overnight, Matt.
All right, it was definitely insane, Kailey. I concur. And I think all eyes really are on the S&P. This is the kind of broad, stable benchmark that isn't supposed to make a 4 or 5% round trip in the span of just a few hours. Right now, we see futures down after the big bout of volatility yesterday. The U.S. 10-year yield up a little bit as investors feel comfortable enough, it looks like, maybe to sell some of that debt. But it's interesting to see that they're selling the debt and selling futures. NYMEX crude right now up 132, which is a good sign for the global economy if you want to take that as an economic gauge. If you want to take Bitcoin as a risk gauge, it's not a great sign today. But look, we're bouncing back over 36,000 at some point yesterday. And remember, we were below 34,000 yesterday morning. So really interesting to see the swing in S&P futures, the swing in risk indicators like Bitcoin, but positive economic indicators in crude and in treasuries. Anna, what do you see in Europe?
Yeah, so equity market futures in the US in negative territory, and we'll keep that in mind as we look at the green on the screen across this European map. We're doing our best in Europe to hold on to that positive territory, doing it quite well. But of course, this map doesn't tell you the context of yesterday. Losing 4% one day, gaining 1% the next. You're not back to where you started, but that's what we've done here in Europe so far today. Who knows where we end the day? Such has been the volatility over the recent sessions. In terms of what is leading the markets higher here in Europe and leading that rebound, the banking sector to the fore, up by 2.2%, despite Credit Suisse underperforming on the back of that news flow surrounding provisions they're making and also outflows from wealth management. More of that later. I wanted to put in here the ruble, and this shows that we're actually gaining on the ruble this morning, just to make the point that we are seeing a bit of a pause in the selling of Russian assets that perhaps had some spillover into other markets here in Europe in yesterday's session. So that's certainly something we're keeping in mind. We're also seeing some buying of Russian stocks in today's session, although keep an eye on Russian ETFs. I'm told one in the US. There was so much expectation, so much wanting to short Russian assets in recent days that they had to create more shares in that particular ETF to enable the market participants to do that. The euro being sold so that investors can get more safety or perceived safety in the dollar, and earlier on in the session in the yen as well. And Ericsson, I put this share price in here, the telecom equipment maker, this stock up by more than 7% today. A really stellar, in the words of some analysts, report from the company today in terms of their upgrades to expectations and the dividend that they produce and the profits. 5G is really the opportunity here, and Sevian Capital is not good enough for them. They are a shareholder here, an activist shareholder. They're saying that this company still has more to do to convince the markets about the possibilities that it sees, Kailey, in 5G.
All right, we'll continue to watch those shares throughout the trading day in Europe and see if those gains can hold. And as for what else we're watching throughout the trading day, the International Monetary Fund will launch its World Economic Outlook update at 9 a.m. New York time. Then German Chancellor Olaf Scholz hosts French President Emmanuel Macron in Berlin. There will be a press conference ahead of a meeting that will focus on the bilateral relationship between France and Germany, France's presidency of the EU, and Germany's presidency of the G7. And finally, after the bell, Microsoft will kick off mega cap tech earnings. It reports at 4 p.m. New York time. So those prints we're getting from Microsoft as well as Tesla and Apple throughout the week, Matt, could be just the next catalyst for a tech sector that has gotten badly beaten in the last couple of weeks.
In one direction or the other. Let's talk about that crazy volatility that we saw yesterday. The market action was wilder than most days in history, with the S&P falling about 4% before ending the session slightly higher, as investors try to gauge the impact of everything from Fed tightening to geopolitics and Russia and Ukraine. Let's get more with Bloomberg's Danny Berger. Danny?
Matt, when we look at that volatility that you're describing, the natural question that comes to mind, okay, is this boomerang market, when we get this turnaround, is that a sign of confidence that we can buy these dips? Well, to be clear, a lot of the signals suggest that the kind of action yesterday hints at deeper market trouble. For one, we can look at the historical corollary. We saw the Nasdaq 100 drop nearly 5%, certainly dropping more than 4%, and then ending higher. We have seen that in the past, 11 times to be precise, but when it happened is not comforting. 3 times in 2008 and 11 times we saw that happen during the dot-com bubble. So if history is any sign, it's not exactly a calm period in the market. But one place that I really love to look at in yesterday's session that really shows the market angst is trading in the ETF that tracks that Nasdaq 100. That's, of course, the Qs. And if I can use a highly technical, very CFA word, the trading was absolutely bananas in this thing. We saw record turnover in this thing. The amount of volume traded in this was almost 70 billion. That's nearly 30 billion more than the prior record. And at the same time, options traded in this thing also were at a record. They're really led by the bearish options. Typically, when there's market angst, it goes into the ETFs because these things are really liquid and really easily traded, Anna.
Okay, so the trading was so bananas you had to colour it yellow, which I think is important in this context. Yeah. Let's talk about the trading in Bitcoin then. Such weakness in Bitcoin, such movement in tandem with stocks, Danny, the correlation between those two moving to levels we haven't seen.
Yeah, exactly. And for our radio listeners, I did have yellow on my last chart for the banana-y-ness of the market. This one, unfortunately, I do not. I'm looking at correlation between the Nasdaq and Bitcoin. Now, the thing here, and I know, Matt, you're not the biggest fan of correlation charts, but I do think this one is telling because previously in 2019, not a lot of correlation, not a lot to take away from this. We have seen Bitcoin and stocks more closely linked, but if anything, it doesn't necessarily say that Bitcoin is a leading indicator. It just shows how Bitcoin is reflecting a very similar concern that we're seeing play through stocks. You see Bitcoin gaining yesterday, eventually stocks gained, Bitcoin taking losses. Now, the new floor, many strategists say for the cryptocurrency is 30,000, which would be more than 50% losses from the top. And it just shows how investor psyche is likely taking a brutal beating when you have all these very speculative assets that people pour to now chopping the other direction.
I'm not anti-correlation chart. Yeah. The function is very sophisticated and it can be easily manipulated for those who don't understand how to use it, but it's a great function, CORR. Go. Danny, thanks very much for that. Bloomberg's Danny Berger talking to us about the volatility. A lot of it seemed kicked off by the geopolitical news yesterday. The Biden administration now is offering a show of military force along with diplomatic efforts to defuse the crisis in Ukraine. The Pentagon has put as many as 8,500 troops on alert for deployment to help NATO forces in Eastern Europe. This comes after President Biden held a call with European leaders yesterday.
I had a very, very, very good meeting, total unanimity with all the European leaders.
Emily Wilkins, Bloomberg government reporter, joins us from D.C. So, Emily, does this mean the U.S. is willing to back a fight against Russia militarily?
So at this point, the U.S. and the Biden administration are really painting this move to send these 8,500 troops as a proportional response to what Russia currently has at the border. These troops are going to be joining NATO forces, sort of supplementing that they're already there. They're not going to go into Ukraine at this point. These troops are not officially deployed. At the same point, this does kind of show the Biden administration taking a stronger stance than what we've currently seen against this Russia buildup at the border. And you've seen both President Biden really focus his efforts here on this particular part of the world in recent days. You've seen Congress go ahead and ask that. Both House Speaker Nancy Pelosi, Senate Democratic leader Chuck Schumer asked for these bipartisan briefings from the White House. And I think at this point, the U.S. is really trying to put itself in a position where they're much more involved in the region should a strike occur.
Well, Emily, you mentioned bipartisan briefings. How much bipartisanship is there on this issue? Is there agreement on both sides of the aisle?
There's actually a lot of bipartisanship here. Even though Democrats and Republicans have some different ideas about what sanctions are needed, you've seen senators come out and say that they realize that this needs to be bipartisan. It needs to be a strong, clear message from Washington to both Ukraine and Russia about where the U.S. stands. So lawmakers, they're not in Washington right now. They're back in their districts, but they are working on a bipartisan bill that could already put sanctions against Russia, potentially even before they invade, if they invade.
Emily, thank you very much. Emily Wilkins of Bloomberg Government with the perspective from Washington. On to the corporate news flow. Credit Suisse will take a large legal charge in the fourth quarter and warns of outflows at its key wealth business. This caps a tough year for the bank after a series of scandals and management turmoil. Joining us now, Tom Metcalf, Bloomberg's European banking reporter. Tom, what on earth does this mean for Credit Suisse's earnings then? This has been a tough time. Now we've got more bad news this morning.
Yeah, exactly. The sort of bad news keeps on coming for the bank, and effectively, if you're an investor in the unit, you're just going to be very disappointed again after, sort of a year of bad news.
Yeah, I was going to ask if they can get out of this cycle, but, it just seems never ending for Credit Suisse, almost like Deutsche Bank a couple of years ago.
Yeah, exactly. That's a great comparison. When people now think of banks in trouble, they turn straight to Credit Suisse. So, the question is maybe they've managed to clear all the bad news out before Q4, and then 2022 looks maybe a bit positive. But, given the past 6-12 months, I probably wouldn't hold your breath for that.
All right, Bloomberg's Tom Metcalf, thank you so much with a look at one of the big banking stories this morning. There's also a story we are following in the chip space. The breaking headline just crossing the Bloomberg terminal. Nvidia is said to quietly prepare to abandon its takeover of ARM. Of course, this was supposed to be a $40 billion chip deal. Nvidia trying to buy ARM from SoftBank. They announced this back in September 2020, and it ran into some serious pushback from regulators. So now reportedly, Nvidia is looking to pull back from that deal. That stock is down about 2 percentage points in pre-market trading here in the U.S. And as for some other stocks on the move in pre-market trading, we do have one moving to the upside, and that is IBM. It reported earnings after the bell yesterday, its strongest sales growth in about 10 years, thanks very much to the cloud. As a result, that stock is up the better part of 3% before the bell. Moving to the downside, though, meme stocks. And this is a very key date for meme stocks, Anna, because it was on January 25th, 2021, that GameStop mania officially kicked off. So it is the one-year anniversary. It has been a wild ride for the likes of GameStop and AMC, but lately that ride has been to the downside. They are each down about 50% over the last 2 months, as you see a lot of money coming out of some of those frothier areas of the market, and those losses are continuing today. They're down about 2.8% and 3.8% respectively before the bell, Anna.
Now for something a little different, Kailey, we have some red headlines crossing the Bloomberg in relation to parties that were said to have taken place at Downing Street during lockdown periods, during the height of the pandemic. We've been covering these news lines for some time, of course. Now we're hearing this morning that the London police are to probe Downing Street parties during lockdown. So they're officially going to open up a probe into this. This is going to be investigated by the police here in the UK. This, according to the Metropolitan Police's Cressida Dick, who is speaking at a hearing. You're not seeing pictures of her there, but she is speaking at a hearing. There are some events that will not be probed, but some of these have been assessed, and the police are going to look into it. This does not mean that penalties will be given. Cressida Dick, you see her there, is saying this morning. Now, coming up on this programme, more on the markets with Elliot Hentoff, State Street Global Advisors, and Matt Maley of Miller Tabak. So much to talk about, from the Fed to geopolitical risk, of course. And talking about that geopolitical risk, what does that do to the European economy? We'll talk to Anna Titareva, UBS European economist. That's coming up shortly. Plus, part of our interview with Bridgewater Associates founder Ray Dalio. What he sees is behind the massive market moves. Don't miss that insight. This is Bloomberg.
The Federal Reserve has been behind the curve, slower to tighten monetary policy. And as a result, we're now starting to see the rise in interest rates to be able to deal with that. As that happens, all assets compete with each other. That means all the other assets have to adjust. We're in a process of making that kind of adjustment.
That was Bridgewater Associates co-chairman, co-CIO, and founder, many titles there, Ray Dalio. I'm speaking on the David Rubenstein Show, peer-to-peer conversations. You can catch that full interview next week on Bloomberg Television. Joining us now for his view on the Fed, Elliot Hentoff, head of policy and research at State Street Global Advisors. And Elliot, we've been hearing a ratcheting up of expectations for rate rises this year by the Fed, and yesterday was no different. But all of a sudden, the markets went haywire around 5:30 this morning yesterday, and it seemed to be on the geopolitical news. What do you think kicked off the incredible bout of volatility?
Yeah, I think, Matt, you and I were just chatting in the break. It's everything going into 2022, we all knew volatility would be up. We're in the process of normalizing the policy environment, normalizing the economy from kind of all the crazy disruption that we had with the pandemic. And it's like going on a roller coaster. You know it will be bumpy. And even though once you expect it, when you experience the bumpiness, it's still somewhat of a surprise. So what happens is when you're normalizing, any small trigger can basically amplify the volatility, can amplify the swing. And that's what we've been having yesterday. It didn't take much to basically turn the market one way and then back the other way. But I want to really point one thing out to viewers. You know, a swing like that, we heard it before from your colleagues. We've seen it in October 2008. You saw it during dot-com bubble. We're nowhere in a systemic problem like we were during those eras. So it's really not justified. So the volatility should shake itself out and normalize too.
Elliot, good morning. Yeah, we haven't seen volatility, the intraday volatility that we saw on the Nasdaq, I think, since 2001, the aftermath of that dot-com sell-off. So that's just the incredible historical context to what we've seen this week in markets. How would you expect the Fed to be looking at what we've seen in markets? And actually, how would you expect the markets to react if the Fed comes out and reaffirms what it's already said about the number of rate hikes that might be on the table and the way it might use quantitative tightening? If it just comes out and says what it said before about what it might or might not do this year, do you think that will calm investors or lead to further panic?
If I was a FOMC member, I would be quite pleased with market behavior in January. You've had clearly a sell-off in risk assets, but you didn't have crazy turmoil in the rates market. I think you just had the 10-year up at 178. Credit's not overreacting either. So in many ways, this is, I think, what the Fed is happy to see. The market is doing some of the lifting of what is required. So I think the Fed could be pretty confident to say we reaffirm our previous stance, we reaffirm the path of travel, and yes, that's not. I wouldn't say it will lead to another bout of volatility, but I think the market will have to take it in stride.
So, Elliot, how much, though, is the Fed going to be able to tolerate? Where is the Fed put now?
That's an excellent question. The Fed put clearly has shifted. I think you're going to see a year of two halves here. The first half is if the Fed action is clearly front-loaded. It's front-loaded to winter and spring of this year. And a lot of it will, as I talked about, the normalization process. Even if the Fed did nothing, you are going to see some type of normalization on the inflation front. But now, obviously, the Fed, as Dalia pointed out, is a little bit behind the curve. So there has to be a little bit more front-loaded action to engineer that normalization. But mind you, the put still remains in place to a degree. We've had a huge risk-on rally for about a year and a half. It's fine if there's a little bit of a drawdown, a little bit of a tightening of financial conditions from the equity market, from the bond market. That helps the Fed. It means they have to do less. And frankly, I think in the second half of the year, our discussion will be quite the opposite as to, how much will the Fed maybe pull back from some of the projections we talked about now in January.
Elliot, I don't understand why you differentiate what we're going through now from what we went through, for example, during the dot-com bubble or the great financial crisis in terms of systemicity, if I can make up that word. I mean, the fiscal and monetary stimulus in the tens of trillions of dollars globally, how does that not cause something as systemic as, an overvaluation of stock market prices during the dot-com bubble, which must pale in comparison?
Yeah, well, the difference is that, first of all, the financial crisis meant our financial system was collapsing, credit channels, transmission for monetary policy was going to be broken, all of that. But the dot-com cycle is different because you had a global downturn happening. So the question was, to what degree could policy support what was otherwise a downturn? Here it's the opposite. You have global growth, maybe not accelerating, but still growing at a fairly healthy clip. Some parts of the world are actually going to be accelerating, particularly ex-US. And so that's a very different environment. The actual earnings that companies will be generating, well, yes, they're disappointing, maybe some of the projections, but they're still pretty decent. This is not a downturn. So it's about normalizing the withdrawal of the morphine that we've got into that we've gotten injected into markets. Pulling that back, it's a little bit of withdrawal syndrome for drug addicts. It's a normalization process, but it's not an existential crisis like it was in the previous episodes.
Elliot, thank you very much. Elliot Hentov of State Street Global Advisors. Thanks for joining us. Now let's get a first word news update. A new Pentagon assessment casts doubt on whether the U.S. Navy's costliest warship can defend itself. The Defense Department's testing office found mixed performance by the combat system on the USS Gerald R. Ford, a $13 billion aircraft carrier. The report also said the carrier's aircraft launch and recovery systems are poor or of unknown reliability. Unilever plans to cut about 15% of senior management roles, roughly 1,500 jobs. Bloomberg reported earlier that CEO Alan Jope believes that the number of managers at the consumer goods giant has slowed innovation. The cuts come at a time when activist Nelson Peltz has taken a stake in Unilever. Shares of Ericsson rose the most in almost a year. The Swedish telecommunications company raised its dividend and reported profit that beat estimates. Like a lot of other companies, Ericsson had to deal with supply chain problems.
Supply chains around the world are very constrained, and it is a difficult supply situation. So far, we've been able to cope with the supply constraints, and the uncertainties are going to be here for, I foresee it into 2023, actually.
Ericsson sales fell in China, but that was offset by demands for upgrades to 5G in the rest of the world. And British Prime Minister Boris Johnson is facing allegations of more rule-breaking parties during the pandemic. His office has confirmed that staff gathered in Downing Street to celebrate his birthday during the first lockdown in 2020. Meanwhile, London police now say that they will investigate the parties, and a government report on the parties may be published this week. That could add to the political pressure on Boris Johnson. And I know that across the Atlantic, the details of this will be lost a little, but suffice to say, there have been a lot of allegations of the parties that took place at Downing Street. We'll wait to see what the internal civil servant inquiry says about this. But the big question is whether Boris Johnson as Prime Minister can survive, and the involvement of police here must make that more complicated.
And I have heard that they partied pretty hard. Is it true? Reports have said they were sending staffers to the local 7-Eleven with suitcases to fill up with booze.
That has been reported. That has been reported, yes. And who was there at which particular party and which particular rules applied at that time, but that certainly was not a good look, especially when that particular gathering occurred.
Not a party until something gets broken, right?
Just before a big state funeral here in the UK. So a lot to talk about there when it comes to the future of UK politics. We'll get back to the markets conversation, though. That certainly is a big preoccupation for us here. Matt Maley, Miller Tabak, Chief Market Strategist, joins us next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. I'm Anna Edwards in London with Matt Miller and Kailey Leinz in New York. And here is what you need to know. Strategists are predicting trouble for U.S. stocks after that massive U-turn left benchmarks in the green. Bespoke Investment says that the Nasdaq historically drops after a big reversal. U.S. futures are lower today. The U.S. has put as many as 8,500 troops on alert for deployment to help NATO forces in Eastern Europe. Meanwhile, President Biden says he had a great call with European leaders, trying to come up with a unified position on Russia and Ukraine. And in corporate news, Credit Suisse is capping a year marred by scandals and turmoil at the top. The Swiss bank will book more charges for legal matters in the fourth quarter. Plus, it warned of outflows in its key wealth business. That is a look at what you need to know this morning. Matt, what do we need to know ahead of the market open in the United States?
Well, we have a couple of conflicting indicators after the massive volatility that we saw yesterday. We have risk indicators that are down, economic indicators that are looking a little bit better. The risk indicators are the S&P futures here down about 0.6%, and Bitcoin down almost 1%. Economic indicators, I would say, NYMEX crude is higher right now, and investors feel comfortable enough to sell off the perceived safety of government debt, as we say. So 178.85 on the 10-year yield, NYMEX crude at 84.29. Bitcoin is interesting because it actually came up pretty strong yesterday. Now it's trading at 36,472, even with this 1% loss. So that's a big turnaround from the drop below 34,000 that we saw at this time yesterday. S&P futures, of course, just unbelievable yesterday, down 4% and then back up to finish positive at the end of the session. There are only a few times in history, Kailey, where you see moves like that.
Yeah, it was absolutely wild, Matt. And of course, we've been talking about the correlation between risk assets and Bitcoin, but there's a very clear correlation between Bitcoin and crypto stocks. And that is evident once again in pre-market trading this morning. We are off the session lows for both Bitcoin and the likes of Riot Blockchain, but it's still lower by a little more than 1%. Also lower is Nvidia. And this is on news that just crossed the Bloomberg terminal about 20 minutes ago that it is looking at abandoning its takeover offer for ARM. Of course, that $40 billion deal ran into a lot of regulatory trouble. And so Nvidia maybe is walking away from that. Right now, those shares are down about 2.5%. There is a positive story out there, though, and that is IBM. It reported after the bell last night, strongest sales growth in 10 years. So that stock is up about 3%. And of course, we're going to get more earnings throughout this week, including Microsoft coming up after the bell today. Anna, ahead of that print and ahead of the opening bell, Microsoft shares are down about 0.3% before the bell.
A large corporate to watch later on. Let's focus on what is trading right here and now, and that is European equities, of course, Kailey. And we're hanging on to positive territory. We sold off 4% on European stocks yesterday, making up around 1%. So we're not making up for all of the losses of yesterday, but we are managing to keep our heads above water here in Europe, despite the moves to the downside, adding in the moves to the downside in US futures. Maybe some of that has to do with a little bit less nervousness and risk aversion towards Russian assets today. This is the Russian ruble actually gaining. We've seen Russian stocks gaining. There is a sense of nervousness, though, perhaps around FX markets more broadly. Some on FX desk flagging that they're seeing euro selling as investors try to get into the dollar or decide to get into the dollar as a haven at a time of increased geopolitical tension. Maybe the contrasting Fed and ECB policies have something to do with that as well. And Ericsson also here on my list because, of course, we've got earnings season coming through. European corporates just starting to get into their stride in terms of that reporting. And this was a positive one. This was a good story for markets, but not good enough for one of the activist investors that has a stake here, saying that this business needs to do more to explain to markets how it can win from the 5G rollout then, Matt.
Well, Anna, I'm going to pick it up here because I think there's a lot of explaining that needs to happen, not just for Ericsson, but also in regard to what the heck happened yesterday. Joining us now to hopefully help answer that question is Matt Maley, Miller Tabak, Chief Market Strategist. Matt, when you look at the action from yesterday, can you draw any logical conclusion about what happened and what that may indicate the path forward looks like from here?
Yeah, Kailey, I think part of it had to do with this situation where we had some forced selling. I mean, we talk about when we get a washout trade or capitulation. And a lot of people usually think, well, capitulation means that we had some people panic, and that's certainly part of it. But also, as we do know that from levels of margin debt and such that there was a lot of leverage in the marketplace going into this year, and leverage helps on the way up. But as the market rolls over, we see some unwinding of that leverage, and I think that's what we saw. I mean, we saw each of the last 3 days of last week, the market closed on its lows of the day, and I think we saw some of that, those margin calls and things like that to kind of cause the forced selling. Yesterday we saw it again, and I think once that finally kind of got washed out and people were done with that, there was nobody left to sell, and that's why we got this major snapback rally.
Well,
the concern though is that.
Matt, are people done with that in general? Was that capitulation? Have we seen it?
That's the big question, Matt, because and I don't think it is. We had a huge, massive levels of margin debt going into this year. It has certainly come down some, but it takes time for that to get unwound. We've seen that in 2018. We had record levels of margin debt. It took several months for that to get worked off. It doesn't just happen overnight. And so I do think that yesterday's bounce will be one that will probably. The futures are down today, but they're down about half as much as they were. An hour or so ago. So I think that bounce should last a little while, but I do think we'll see, more volatility and probably lower lows. So I think we've gone from a situation that on a near-term basis that people need to sell the bounces rather than buy the dips.
I hate to ask you kind of the horse race question, but it begs to be asked, how much lower could we go? I mean, before that margin is all unwound, where do we end up?
Yeah, I think when this whole thing kind of came around, especially around November and December, when the Fed really started signaling they were going to be much more aggressive with their tightening, I really thought we'd see a deep correction in the S&P 500, take us down 15 to 20%, and I still think that's probably going to be the case. Which, of course, take the Nasdaq down even further. The thing for investors right now, though, is so important is that maybe raise a little bit of cash, not a lot. You don't have to raise 25% cash, but you raise a little bit of cash on the bounces, and therefore, I mean, my point is, embrace this situation. They're healthy, they're scary, but they're also normal, and like I said, healthy. And if you're the ones who can embrace it, you'll be the one who's keeping your head while others are losing theirs at the bottom, and you won't be selling right at the bottom with the absolute worst time. You'll be the one who has the confidence to buy.
Matt, in the context of that, if we're right-sizing monetary policy right now, if that is what the Fed is trying to do, get the monetary policy support level right for the economy that the US sees right now, what does right-sizing equity markets look like? Where do we get down to, perhaps in relation to March 2020 levels, for example?
That would be, of course, be very, very deep, because then we're looking at more like a 30% correction. That is possible, and because we tend to overshoot in both directions. We overshot to the upside last year, and we could overshoot to the downside. The thing is, though, is that they're normalizing interest rates, they're normalizing the balance sheet. That means stock prices and stock valuations need to normalize. So I think we need to see those get down into the 16 times, 17 times earnings, and things like price to sales, which is even more important than I think most people realize. Get those normalized, and again, that will cause closer to a 20% pullback rather than the 10% we've seen in the S&P so far.
Matt, what do you think is more important this week, the Fed decision tomorrow or the tech earnings that we get over the next 3 days?
I think the tech earnings is going to be the most important. I mean, we kind of know what the Fed's going to do. If anything, they might be, a little bit softer. I don't think they will. I think they're going to, to keep their, their viability, they need to stick with what they've been saying. But we know what that's going to be. Where the uncertainty really lies in the tech earnings. So if they can come through a little bit better, we see IBM with some good numbers this week. Last night, we see Microsoft and Apple. That will certainly help the market on a near-term basis. And again, when markets see corrections, deep corrections, they never come in a straight, or almost never come in a straight line. We see sharp bounces along the way. Hopefully, we can get something out of Microsoft, Intel, and these other names. Alphabet, Google, especially, could be one of the names that could really help the market stabilize here.
Yeah, we'll see how much comfort we get from that tech earnings story. Matt, thank you so much. Matt Maley, Miller Tabak, Chief Market Strategist. Coming up on the programme, we'll be back to talking about geopolitical risk. What does that mean for European equities? What does sanctions mean for European economies? Anna Titareva, UBS European economist, joins us next. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. You're looking live at the Principal Room. Coming up later today, an exclusive interview with Jeff Currie, Goldman Sachs Global Head of Commodities Research. This is Bloomberg.
There is a confirmation of unity of the European Union. There is a confirmation to help Ukraine to address this crisis, and also there is a readiness to take measures if necessary and to impose new sanctions, both individual and sectoral sanctions on Russia.
Ukraine's ambassador to the European Union speaking with Bloomberg's Maria Tadeo earlier this week. For more on the crisis over Ukraine, we're joined now by Rosalind Matheson, Bloomberg Executive Editor for International Government. Rosalind, help us understand where we stand on the risk here, because when we listen to Ukraine, they seem to want support from Western allies. They want equipment, for example, and they clearly don't believe Russian assurances that no invasion is planned. But at the same time, they don't want to see anything that looks like panic, and they didn't respond well to embassy family members being withdrawn from the country. What's the latest?
Well, that's right. You can see that even as tensions are definitely increasing, you're seeing a high level of caution on all sides about what they're saying and what they might do, even as the US and NATO, for example, are saying that they're prepared to move NATO troops further into Eastern Europe and to bolster that area, including with exercises and ships, and as countries including the US and the UK ship more defensive material into Ukraine, they're all saying all of this is defensive. None of it is about trying to prod Russia into action or to goad it into doing something, and reassuring, if anything, Russia by saying, look, just because they're all there doesn't mean that we're preparing to do something. And also they're very clear that they're not prepared to send troops into Ukraine itself if conflict does actually break out there. So you're seeing trying to send a message of toughness and unity, including on the military side, but also not going so far as to take action that might force the Russian president's hand in terms of moving perhaps into eastern Ukraine and starting an incursion or even a broader invasion.
Minor incursion or a full-scale invasion and occupation. Roz, it's hard to talk tough when you rely on the aggressor for your energy needs. Is it possible, I mean, if Russia were to go into Ukraine, would Europe even be able to stop funneling Vladimir Putin billions of dollars to fund his antics?
Well, that is the real difficulty, and you're seeing European nations essentially contort themselves a bit at this point in time about how they would respond. Like, what kind of action, for example, would warrant sanctions, would warrant heavy penalties? Is it incursion? Is it a full invasion? Is it a cyber attack? Is it efforts to destabilize Ukraine from within? What kind of action on his part would warrant sanctions, and then what kind of level of sanctions even? And right now, European nations are very cautious about discussing specifics on sanctions among themselves out of those concerns, and as you note, very much reliant on Russian gas into Europe. And that makes Europe much more vulnerable to economic hits from this than, say, the US. And that's why you're seeing differences, perhaps. The US is pressing really hard for a proper sanctions package to be developed, and Europe just remains much more cautious because they're really close to Russia in terms of retaliation, economically and otherwise. And that's a real difficulty in that unified message again.
All right, Bloomberg's Rosalind Matheson, thank you so much. And let's continue this conversation now with Anna Titareva, European economist at UBS, who joins us now for more on this Ukraine issue. Just to pick it up on that point, Anna, can Europe withstand the economic consequences if severe sanctions are put in place on Russia?
When it comes specifically to the impact of sanctions, when we look back at, for example, 2014, there are some estimates that suggest that the impact on Germany of the sanctions introduced by the EU accounted for about 0.2 percentage points loss of GDP. Now, given that the share of exports to Russia at the Eurozone level is somewhat lower than for Germany, the impact on the Eurozone would likely to be even smaller than that. So overall, that seems that the impact, at least looking at previous periods, seemed to be relatively small.
You say relatively small. We're showing a chart here, though, Anna, that talks about lost trade due to sanctions on Russia going back to 2014 and the period around it. Even if it is relatively small, relative to other European nations, the risk, the economic risk, falls heavily on Germany. And those links, those economic links between Russia and Germany, well known, of course. Does that go some way to explain why Germany finds it perhaps more difficult to come to a common understanding with other European leaders on sanctions?
Yes, certainly Germany seems to be the most exposed given its trade channels. But even aside from that, when we look at sort of the most immediate channels of how the shock is likely to feed through, we emphasize two channels, confidence and also price effect, price channel. We've seen that a big spike in gas prices last year already had a very significant impact on the region. We saw a big increase in retail gas and electricity prices across the region, eating into households' real incomes and also, production costs of businesses. So any worsening in geopolitical situation risks another spike in gas prices, which would further weigh on consumption across the region and also would likely affect inflation dynamics, at least in the near term.
What kind of inflation expectations, Anna, should we have for Europe outside of, the geopolitically caused gas spikes? For example, wage growth, is that as substantial in Europe as we're seeing in the U.S.?
Yes, so overall, we think that the 5% inflation print that we saw in December has likely marked the peak in the Eurozone inflation profile. We do expect a decline in January that's largely driven by sort of mechanical factors related to German VAT and CO2 pricing scheme. However, risks, both in terms of near-term and medium-term, are skewed to the upside. Near-term risks are largely around supply bottlenecks and also, importantly, energy prices. And wage growth is, we think, the key factor to look at when we talk about a medium-term inflation outlook. Final point I would make regarding wage growth: so far throughout the pandemic, wage growth has actually slowed down at the Eurozone level, but we do expect this to change this year, and we do expect a significant pickup in wage growth, especially in the second half of the year.
Anna, thank you so much. Thanks for joining us. Anna Titareva, UBS European economist, with reflections on the risks for the Eurozone economy and the links with Russia. Coming up on programming a little bit later, Geeta Gopinath, IMF First Deputy Managing Director. That conversation at 10 a.m. in New York, 3 p.m. in London. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Anna Edwards in London. And also joining us now, Tom Keene, co-anchor of Bloomberg Surveillance, trying to help us make sense of these markets. Tom, can we draw any conclusion from what futures trading or even early trading indicates about where we're going to end the day?
Really good question here. What I do is I triangulate across the equities, bonds, currencies, commodities, and I sort of see a soup and a mess. And maybe, Kailey, that's because we're upon a Fed meeting. But the gyrations yesterday were extraordinary. I know everyone's seeing all sorts of historical looks. What I did is just go to the VIX and the big figure move in the VIX. And we all know this is, not so much never been seen before, but a hugely rare occurrence. Higher is ugly, the red, and that's 19 points, I believe, 19 big figures way through 30 level. And then we came in abruptly into the yesterday's magnificent 27 big figure move in the VIX. I will say there's been a lot of analysis that this is maybe something we'll see to lower equity prices in the future. I'm not predicting that, but that's where we are as we pick up the pieces this morning.
Yeah, no escaping the volatility then, Tom, it seems. Certainly extensive in yesterday's session, and some of that spilling into Europe as well. I was talking to a guest earlier on today about, if we are, broadly speaking, trying to right-size monetary policy, that is going to have an impact then on the right-sizing of stocks. And it's interesting to think about where that takes us on stocks. One guest suggesting that could result in a 20% drawdown on the S&P.
You got 5 people, you got 6 opinions, Anna. I'm not going to go there. What I will say is Ben Laidler, who's been wonderful since Christmas Eve of 2018, reaffirms his bull market call this morning. He says this is highly normal, and he looks again for earnings to surprise. And as you know, we get some nice important industrial reports today in 3M and in GE as well.
All right, Tom Keene, co-anchor of Bloomberg Surveillance, thank you very much for joining us. And other than the trading action and Fed policy, take a look at what else we're watching today. I am watching mega cap tech results. Microsoft will be first out of the gate after the bell today. Remember, this is a stock already down 12% in 2022, so the bar's pretty low going into the print. My question, Matt, is can Microsoft today, Tesla and Apple over the coming days revive this tech sector, which even after yesterday's slight gain into positive territory is still really, really bruised badly on the year thus far?
Yeah, I think everyone's going to be watching that incredibly closely. I'm also going to be watching the car sector as usual, but I have a very special guest later on today. I'm going to talk to one of the preeminent car guys of old Detroit, Mark Royce at GM, who is also laser focused on climate and EVs. I remember about a decade ago driving around Detroit with him in a Chevy Bolt. And now, of course, they've released a new Silverado EV, or they've shown it. They've got the electric Hummer coming out. So we'll talk about that. But I also have questions about big, old gas engines. I still love the 6.2-liter V8 that they've got in the Silverado, Sierra, Tahoe, Yukon, and I wonder when that's going to be hybrid. I have a million questions for this guy, so I'm pretty pumped.
You have. Yeah. I hope you've got a lot of time for this conversation, Max. It sounds like you've got a lot to fit in. I'm going to be watching UK politics. We heard at the top of the hour from the Metropolitan Police Commissioner, so the commissioner who runs the police force here in London, that they are going to be investigating allegations of parties at Downing Street, the home and the workplace of the Prime Minister Boris Johnson during lockdowns in 2020. Well, I say 2020. We're not sure exactly which of the parties that are alleged to have taken place the Met Police is going to be investigating, but they will be looking into some of them. We're also waiting for a report from a civil servant, Sue Gray. I would say that the timing of the news on both of those, that report and the investigation by the Met, now pretty unclear. So we'll have to wait and see when those land as to what the polling looks like and what the political fortunes then of the Prime Minister will look like. More Bloomberg Surveillance is ahead. We'll hear from Ryan Williams, Cadre Partners CEO, and others. This is Bloomberg.